Welcome back, everybody, to the Schaefer Stock Market Podcast. This is Josh Selway again. I am an editor at Schaefer's Investment Research. We've been doing these every week for a few weeks now, and I want to thank everyone who's been listening. We've gotten over 2,200 downloads so far, and we're just getting started. If you didn't listen to last week's episode, we covered everything that's been happening in the video game industry. There's been so much happening. I could have went on longer and longer and longer if I wanted to, but the idea of these is to keep it short, keep it sweet, and just give you a brief rundown of some things that have been happening in the stock market and in the financial news industry. So that is what we're going to continue to aim to do every single week. This week, we're going to be covering the healthcare sector because there's a lot been happening there, and we have some more congressional testimonies coming next week. But first, I want to give a brief rundown of what's been happening generally in the market. Stocks in the U.S. are set for a weekly win, and we continue to wait for more information on U.S.-China trade talks. There were some reports this week that some progress has been made as far as intellectual property and technology transfers. Those have been the most sensitive subjects so far between the two countries. In the beginning, it didn't look like China was willing to budge at all on that. And of course, that was the U.S. On the U.S. side of things, that was their biggest complaint, biggest sticking point. So potentially, according to news reports, some progress has been made. China has been willing to make some changes there. And all we've really gotten this week from U.S.-China officials is these little quotes such as talks were positive, talks were constructive, and that's really it. No more specifics other than that, and some general positive headlines saying that progress has been made. And those talks are ending today as I speak, so maybe we'll get some more information out over the weekend that'll help clear that up and set stocks free, because right now traders are really struggling to send stocks too far in either direction right now. So maybe some clarification on the trade front will help with that. And of course, we have these lingering concerns about a potential recession. That continues to be the word that is tossed around more and more these days. We had the inverted yield curve, so we'll have to monitor more economic data going forward. But I will say that I've been reading some of these regional Fed reports, and the quotes out of local businesses still say that business is strong. They're trying to hire people, and the number of job openings in the U.S. continue to increase, even though we're at a very tight labor market. Unemployment is at near all-time lows. So that's where things stand generally. And we should also call out today's big IPO, Lyft. The ride-hailing company is going public today. It's its first day publicly trading, and the stock is soaring. It was last seen up around 10% or so, so a well-received public offering for Lyft. But most of the stories about Lyft so far, and Uber too, who is obviously the bigger rival for Lyft that is expected to go public in the coming weeks or months. The stories behind these companies has mostly been about how much money they've been losing, and it really is a pretty staggering amount of money. Of course, the goal is here supposed to be looking for the long-term growth, and eventually someday they'll get profitable. But right now, a lot of people are bringing up memories of the dot-com era, and back then all these companies were going public and they were nowhere near being profitable, and that's what we're seeing again here with Uber and Lyft. And they are really spearheading this new wave of private sector unicorns, if you will, who are expected to go public in recent years. Of course, you have Airbnb is another big one that many people are speculating will go public soon. Pinterest, there's been a lot happening there. Lyft, so far a positive reception, and we'll see if it can hold that momentum going forward, and if investors will forgive it for burning through so much cash. So, to healthcare. Next week, we're seeing pharmacy benefit managers head to Washington, D.C. to testify before Congress. There's been a lot of speculation on both sides about pharmacy benefit managers. A lot of people will argue that they help reduce drug prices. Other people will say that they are the reason that drug prices are so high. They're the middlemen that push up prices. And there's a lot of arguments on both sides. But when I was doing a quick bit of research about this, I found this article by John Arnold, and it is on statnews.com. It's called Are pharmacy benefit managers the good guys or bad guys of drug pricing? Pretty straightforward. And what attracted me to this article, this was from all the way back in August, actually. It was still relevant, I thought, because it took a pretty fair stance. It wasn't trying to take a radical view either way. It was trying to sift out what's been happening with pharmacy benefit managers. And just for some background, pharmacy benefit managers were essentially supposed to be these larger buyers that were going to work with drug companies to help lower drug prices, where they can buy more at a time and negotiate lower prices and essentially pass those lower prices on to customers. Well, over time, as what tends to happen in our healthcare sector in the US, things got more complicated, and what started off as a good idea has slowly deteriorated. And what this article is saying is that we don't need to get rid of pharmacy benefit managers or totally blow up their business models, but we do need to change them and get back to the original idea. And if you want to look up this article again, it had some interesting ideas about how we could fix that. Either way, I'm not going to pretend to know much about this. Again, healthcare is very complicated. Not here to have an opinion on either side, but it's just giving some background on what these are and how people see pharmacy benefit managers. And as this article says, there are three big players in this space. They are CVS, Express Scripts, and United Health's Optum business. Those account for more than 70% of claims, according to this article. Now, we actually just touched on one of those big players, and that was CVS. And over at schaefersresearch.com, we noted that there has been increased put activity, put trading on CVS. And right now, CVS stock is trading just above the $50 mark. However, there was notable activity at the April 50 put. Anyone buying those put options would be betting on CVS stock falling below the $50 mark in the weeks ahead. So this may be someone eyeing these congressional testimonies and expecting the stocks to struggle while they're in that spotlight, probably going to get hammered by members of Congress who like to really vilify whoever's in there giving these testimonies. So good luck to CVS, but some traders here expecting CVS stock to fall, it would seem, by buying the open put options at the 50 strike. The other big story out of the healthcare sector was Centene, ticker CNC, buying Health Insure WellCare Health Plans, ticker WCG. Centene is the big Obamacare marketplace insurance provider, and they're now obviously buying WellCare. This was valued at just above $17 billion, so a major deal here as there's more consolidation in that insurance space. And what was interesting, I was reading up about this, that this comes obviously as the Trump administration again renews its effort to get rid of Obamacare, and the Trump administration would like to set its own path forward with healthcare and do it its own way. But Centene CEO, when I was reading about this, it said that he said that while changes may very well occur with Obamacare, he said it will not go away. So I thought it was pretty interesting how confident he was that at least the essence of Obamacare is not going anywhere anytime soon. So we'll see if that holds true going forward. Another story that continues to generate buzz is all these lawsuits coming on Purdue Pharma. That is the company that made OxyContin and is being accused of deceptive marketing practices that essentially led to the opioid epidemic that we're seeing now in the US. This stems from the Sackler family, which owns the company, and Purdue Pharma and Sackler family just reached a $270 million settlement with the state of Oklahoma over a 2017 lawsuit. And Purdue Pharma was named in this lawsuit on top of Johnson & Johnson and Teva Pharmaceutical, who we covered over at schaeferresearch.com. So we'll see if Teva continues to be brought up in these lawsuits going forward. The stock has been falling in recent months. It was trading around $24 back in November, and now it's all the way down to around $16. Moving on to some more positive news. One stock we looked at this week was immunotherapy stock AFAMED, ticker AFMD. That came after the company released its full year 2018 financial report. That drew some bullish attention from Wall Street. BMO, the brokerage firm, raised its price target to $7. Leerink began coverage on the healthcare stock with an outperform designation and an $8 price target, which that's around the consensus view that analysts have for AFAMED. Most analysts, in fact, all of them, have strong buy recommendations on the stock, and the shares are trading in the $4 range right now, so consider that consensus price target is above $8 per share. There's substantial upside there if you're going by what analysts are pricing in for Affimed. Again, that's an immunotherapy stock. Immunotherapy is a treatment method for fighting cancer that has been gaining more popularity in recent years. Another stock that's been making huge moves, Aksum Therapeutics. I like this one because it looks like Awesome Therapeutics. Aksum Therapeutics, ticker AXSM. That stock soared this week after the FDA gave its major depressive disorder treatment breakthrough therapy status. That is always a big deal, and that designation came after the company released some positive phase 2 trial results for that treatment. This news helped send Aksum Therapeutics stock to a record high. This stock has been soaring. It came into 2019 trading in penny stock territory, and now it's all the way up around $16 per share. It ended up hitting an all-time high near $17. And again, it's up almost like 500% or something crazy in 2019. So definitely a name to watch going forward. Therapeutics, ticker SEEL. That stock jumped to the top of the NASDAQ today after the company released its 2019 business outlook. And one interesting takeaway from this was that it announced an early stage study of its ketamine PTSD treatment that'll be occurring this summer. Ketamine is something that has been gaining traction in the healthcare community as more people look for different types of treatments that help people with certain psychological issues and different types of things like PTSD and depression and other things that have been affecting people. And I know that sort of out of the box type treatments have been gaining traction with the FDA. They're doing new types of studies there. Even things such as psilocybin mushrooms have been used, and the early results for all these types of things, including ketamine, have been quite positive and really suggest that these types of treatments could have significant results for people who right now are struggling to find a path forward. So definitely something to watch in the future as these trials begin in the summer. And again, that is Therapeutics, who will be putting on these studies with its ketamine treatment for PTSD. And another name to watch here is Maron, ticker AMRN. That stock popped this week after the American Diabetes Association recommended Vascepa, which is the company's drug, and they are recommending that for people with diabetes and certain types of heart disease. Now, a positive data set for Vascepa initially sent a Maron stock soaring back in September, and it's basically held that territory ever since. This latest recommendation from the American Diabetes Association was met with positive reviews from the analyst community. Cantor Fitzgerald in particular reiterated its overweight rating on a Maron stock and a $35 price target, which is well above where the shares are currently trading, last seen around $19 per share. So they see significant upside there for a Maron, ticker AMRN. One last thing I wanted to talk about here was that the FDA has proposed changes to its mammogram procedures and standards for the first time in about 20 years, and that's great news. There's been a lot of new research about breast cancer and how to tell if certain women are at risk. So it's good to see them take action and make the changes according to this new research. And one stock to watch considering this news is Hologic, ticker HOLX. That is a diagnostic medical imaging solutions provider focused on women's health. And they released a statement applauding these changes. So hopefully this is a positive development for women seeking health treatment, particularly when it comes to breast cancer. We're going to leave it right there with this episode of Schaefer's Stock Market Podcast. Really jammed in a lot of information in this episode, and that is the goal every single week, to give you a good starting off point for your own research and to keep you up to date on everything that's happening in the business and stock market world. If you want to stay up to date with Schaefer's, check us out on Twitter, StockTwits, Facebook, Instagram, or just go straight over to schaefersresearch.com. We have a bunch of free newsletters that can help you out and stay current as well. But until next week, this is Josh Selway. Thank you so much for listening. I'll talk to you soon.